Risky assets taking a backseat to safe havens Wednesday. Treasury yields keep falling below 2.3%. Right now, the S&P 500 down around 0.8%, below the key 2,800 level. Let's get some perspectives and picks from Oliver Pursche. He is Chief Market Strategist at Bruderman Asset Management. Welcome back.
Thank you, Fred.
Oscar. Oliver, so what's pressuring equities today? Is it still the China trade front?
Well, absolutely. That's still very much at the front. I think you've got a confluence of events that are happening. Trade is absolutely front and center because it's become very clear that a trade deal is not anywhere near. And just a couple of weeks ago, both sides were talking about it being very close to done. So that's number one. Number two, you had European elections this past weekend where the centrist parties got trounced across the board. Whether they got beaten by right or by left wing, it doesn't matter, but the extremist sides really made big inroads, and that's being viewed as very destabilizing in a continent that's already in a lot of trouble, with Brexit, of course, now looking more and more likely to have a no-deal Brexit, which is very problematic. So those are the two geopolitical factors that are driving things. And then in general, you've had some, and to us, that's actually the most critical factor, you've had almost every advanced economic indicator really slow down in the month of May, where things were looking pretty good in April. Starting in the beginning of May, last 2.5, 3 weeks, things have really taken a turn for the worse. And so on a fundamental basis, there's a real question now as to how much the U.S. is going to slow down. And some are even saying that perhaps you'll see a recession at the end of this year as opposed to in 2020, like most were forecasting.
Well, speaking about the economy, Treasury yields keep dropping further, and you pointed out the weak economic numbers earlier. But looking at the S&P 500, we've got it below 2,800. At one point, below the 200-day moving average today. How much more downside do you see in the equity markets, given the picture you painted?
Well, so I'm not a technician, so I can't speak about the very short-term volatility. I think it's fair to say that given that we're going into the summer months where volume tends to be lighter and therefore it takes less selling pressure to have more pronounced moves, it's reasonable to expect some further downside from here. I don't think that we're anywhere near panic levels. Stocks seem to be reacting fairly rationally given the entirety of news that's out there. So to us, if we look out through the end of the year, we think that we're pretty much going to end where we are. There's going to be some opportunities on a sector-by-sector basis as well as individual companies on a fundamental basis. But in terms of looking at the S&P 500 as a whole, 2,800 is probably where we would expect to end up. And by the way, that's been our call since the beginning of the year, late last year. So all right, we haven't changed that much.
What about the asset allocations? What are you recommending investors get into or get out of at this point?
So we are underweight emerging markets. We're overweight fixed income, but really just on the short end of the duration of the curve and with high credit quality. So we're using that not opportunistically, but really just as a volatility mitigating factor. And then large cap U.S. equities. And specifically for that, we believe that it's important to buy what we call category killers. These are companies with strong balance sheets. They're improving their profit margins. They're taking market share away from their competitors. And when possible, are returning free cash flow to investors via dividends and share buybacks. So those are the types of names that we want to. And counterintuitively, that means looking at growth companies, not at value companies.
All right, growth companies, give us a big tech name here.
So Microsoft probably is the biggest name out there. Nadella has done a great job, not just in changing the culture of the firm, which has been incredibly important, but also in developing the business lines. I mean, they're just killing it everywhere. And that's the type of company that you want to own in an environment where things are slowing down.
Talking about categories such as what, cloud computing?
Cloud computing, data storage, you name it, all their business, enterprise software, they're leading and gaining market share from their competitors. And that's what we look for in an environment, because when growth is scarce and you can find growth, especially at a reasonable price, there's a premium that's not been recognized there.
And I might note that the Microsoft shares have not sold off heavily compared to the other big tech names.
And it's a big holding in our portfolio, is full disclosure.
Okay, thanks a lot for making that disclosure, Oliver. Our thanks to Oliver Pursche of Bruderman Asset Management. I'm Fred Kantayama, and this is Reuters.